P2P investing is one of the newest ways you can diversify your portfolio. How does it work? Is it safe? And what kind of returns can you expect? Here is our unbiased review of Funding Societies SME debt investment product. P2P lending is like being an angel investor for small businesses. You lend them money and they pay you back with interest. But if you're like the rest of us, you can't afford to do this alone. So, platforms like Funding Societies allows you to pool your money together with other like-minded people. What this means is that your investment goes towards helping SMEs to secure financing for growth whilst offering you, the investor, an opportunity to earn returns. So, what are the key features of Funding Societies SME debt investment? They offer potential returns of up to 14% per annum. You get to choose your own investment period from between 1 to 24 months, and you have the option to invest from as low as 100 ringgits. For inexperienced investors, Funding Societies has an algorithm to help you decide on how to allocate your funds. The platform also comes with a ton of features to streamline the investment process, such as the ability to e-sign your contracts, and it has a mobile app. Now that you know what Funding Societies SME debt investment is all about, here is what we like about it. Good potential returns. Earning up to 14% per annum puts this investment on the higher end of returns. Now, this is especially good when you compare it to traditional forms of investments such as fixed deposits and unit trust. Full control over duration. The short lock-in periods allow for you to reinvest with a higher frequency and offer greater liquidity. Low barrier to entry. You can start investing with as little as 100 ringgits. This makes it easy for you to test the waters and see if P2P lending is worth your time. But these are also things that you should consider before investing. Higher risk investments. Now, your ROI depends on small businesses staying afloat and repaying their loans. Needless to say, you stand to lose your whole investment if they go out of business. The short investment period also increases the risk as you will not be able to ride out any market fluctuations. Limited portfolio choices. Now, we cannot overlook the fact that SME debt investment only allows you to invest in SMEs that are registered with Funding Societies, which means that your options are kinda limited. In conclusion, we recommend Funding Societies SME debt investment for experienced investors that are looking to diversify their portfolio. The low barrier to entry could make it attractive for new investors who may want to experiment with P2P lending. However, you may need to do your homework on investing in small businesses before you start. If you're interested in learning more about Funding Societies and SME debt investment, click the link in the description. That's all for our review this time. If you like the content, please subscribe and leave a comment.